Welcome back to the Commercial Real Estate Show. I'm Michael Ball. My producer reminded me to tell you guys, my listeners out there, please come see us. I'll be in San Diego next Sunday speaking at the National Association of Realtors Conference and Expo, 1:30 on Sunday. I'll be there in San Diego. I'll be speaking about the top 10 success strategies for commercial agents. So if you attend the event, please come by and see us. Well, today we're talking about REITs, Real Estate Investment Trust. We have Calvin Schnure and Brad Case with NAREIT with us. And gentlemen, as we're talking about before the break, I think a lot of people have varying opinions on how rising interest rates might impact commercial real estate. But what would be the difference in the how rising interest rates might impact commercial real estate and in how they might impact REITs?
Yeah, you know, we mentioned before that real estate throws off very strong, steady income because it's the lease payments from the tenants, and REIT investors get that because REITs are required to distribute most of their taxable income, and so that has led people to say that real estate and REITs are kind of like bonds. They you know, very, very steady income. The steady income part is correct, but that doesn't mean it's like bonds. When interest rates go up, the value of a bond goes down. And the reason is that bonds are fixed income assets. So the income doesn't change even if the interest rates go up. And the reason that's important is that typically, as Calvin said, when interest rates go up, it's usually because the economy is doing better. So with a fixed income instrument, you don't participate in that improvement in the economy. Instead, your discount rate goes up and the value of your asset goes down. But with real estate and REITs, when interest rates go up because the economy is improving, then you are participating in that economic growth. The income stream that the real estate produces increases. That increases the payments that you as an investor get, and that increases the value of your assets. Now, that's not a guaranteed relationship. As Calvin mentions, other things affect the values of assets, and so there have been times when interest rates are going up, but REIT property values, REIT asset values are going down. But the normal response, historically speaking, in periods when interest rates have been increasing, is that REIT investors have done well, and in many cases quite well, because of the fact that the value of their investment in real estate is increasing.
Also, another thing to keep in mind is the cap rates right now are quite low. I know it's reasonable that people are asking the question about the exposure to interest rates, because cap rates right now are about where they were 2005, 6 in the run-up before a decade ago. This raises the question of, if cap rates are so low, are the sectors, both commercial real estate and the REITs that are investing in commercial real estate, are they going to be exposed to interest rate increases? Because the cap rate is very similar to a bond yield. It's the net operating income divided by the value, the current market value of the property. What's different now from 10 years ago is the treasuries are so much lower. The yield on treasuries is so much lower than it was 10 years ago. So the cap rate spread to the treasury rate, which is really what matters for the investors, the cap rate spread to treasuries is 75 basis points, 100 basis points, maybe more wide to where it was a decade ago. What that means is we have room for a 75 to 100 basis point increase in treasury yields without really having any impact on real estate valuations. And this is going to happen during a period where we're seeing net operating income rising pretty strongly. So the increase in net operating income is going to allow cap rates to rise organically with continued property valuation.
Yeah, and that makes sense that as the economy does better, you'll have more demand for commercial real estate and potentially higher rental rates and higher occupancy. But what do you say to the investor who feels like, well, some of these REITs do have some amount of secured debt on these properties, and if their cost of capital on the secured debt goes up, that it could hurt the valuation of the REITs?
2 points. First of all, a lot of the debt's long-term. A lot of the debt is long-term, so it's not going to reprice fairly quickly. The other is long-term interest rates are low and are likely to stay low. We're in a global environment with no threat of inflation, with a lot of liquidity, yields are low across all the countries, not just the U.S. The Federal Reserve has made it pretty clear that they're going to be quite gradual in rate increases, so it'd be highly unusual to anticipate a sharp spike in borrowing costs here.
Yeah, a well-run REIT is paying attention to its exposure to the possibility of increased interest rates. So it's locking in fixed rate debt when interest rates are low. It's making sure that it's prepared so that any increase in borrowing costs doesn't hurt it. And in fact, if it's got fixed rate debt and interest rates in the market go up, then the value of that fixed rate debt goes down. That actually improves their balance sheets.
Yeah, I think a small increase in interest rates would be a good signal to everyone. I think the economy's doing better. Well, we're going to have to take a short break. When we get back, we're going to ask the question about bubble. There's some people talking about some of these assets may be overpriced. We'll get their opinion. We'll be right back. Stay with us. I'm Michael Bull. This is the Commercial Real Estate Show.
The Commercial Real Estate Show is brought to you by Bull Realty, a great place to do business. Xceligent, information for the professionals. And Commercial Search, properties for sale and lease. To access these companies or for additional videos, podcasts, and articles, visit CREshow.com.